Good morning. Welcome to CurrencyChange Daily Market Updates on Monday, 19th of August. It is a quiet start of the week with no major data releases due today. In the United States of America, the dominant theme is on speculation of when and at what pace the Fed will reduce its asset purchases in place since March 2009. Lawrence Summers seems to be the favorite from the White House to succeed to Ben Bernanke. Data last week, which is a key point for the US, supported the views that tapering could be announced at the September FOMC meeting, pushing global bond yields higher and unnerving equity markets. In fact, we observed that US 10-year Treasury yields climbed above 2.8% for the first time in over 2 years. The US dollar seems to be losing some of its pluck, especially against the other majors. Japan, after all, is in the midst of doubling its monetary base, yet the trade-weighted dollar is not making new highs. The euro is higher against the dollar than in May, when tapering talk began. Dollar bull markets historically happen twice, in an environment of positive real yields, and the last time was from 1995 to 2002. At that time, US benefited from gains in productivity from new technologies with deflation in China. We presently observe deflationary pressures in Europe and US gains in productivity coming from the shale gas boom, which will cut energy costs. We observe also that in the US, correlation is positive between equity markets and the US dollar, which is something new. Focus this week in terms of economic statistics will be on the minutes of the July FOMC meeting, which will be released on Wednesday, and on existing home sales, but also on Friday we will have home sales. The annual Jackson Hole Symposium from Thursday will also draw interest as central bankers and leading academics share their latest views on monetary policy. On the Europe, economic data last week confirmed the end of recession in the euro area in Q2. The August euro area PMI data, which will be published this Thursday, might show some further improvements. This is what the market expects. On UK, the pound extended its gains last week as the trend of positive UK data continued, but the country is still exposed to potential higher interest rates. This also saw a widening disconnect between market implied interest rate expectation and the intent behind the Bank of England forward guidance with its new governor, Mark Carney. Meanwhile, benchmark UK 10-year gilt yields climbed above 2.7% for the first time since October 2011. Although there are few key releases this week, the second estimate of UK Q2 GDP on Friday could elicit an upside surprise, while the first look at the expenditure components will draw attentions. In terms of exchange rate, we're currently live on sterling euro at 1.1723 and on sterling dollar at 1.5622. For the economic agenda, there are no major indicators today. If you require further information, visit CurrencyChange.com or contact us, please. Have a great week. Thank you.